In earlier chapters, you learned how real estate is valued, financed, and transferred by contract. Chapter 23 shifts the focus to what happens after a property is acquired and leased. Who runs it day to day? How income and expenses are controlled? How risks are managed? And whether this specialty is a good fit for you as a real estate professional. As a general salesperson, you may not intend to become a full-time property manager, but you are expected to understand how management works, where your agency duties begin and end, and when you must involve your broker or refer to a specialist. The role of the property manager. Property management is the branch of real estate devoted to leasing, managing, marketing, and maintaining property for others. The manager's purpose is simple to state but complex to deliver. Provide the owner with the highest possible continuous net return consistent with the property's best use, while providing tenants with good service and fair value for their rent. There are several types of managers. An individual broker or firm may manage properties for many owners. A building manager may focus on one large project, such as an office tower or shopping center. A resident manager may live on site in an apartment complex and handle daily operations. Regardless of job title, the manager acts as a fiduciary for the owner, which means they must obey lawful instructions, act with loyalty and reasonable care, account for money accurately, and disclose material facts. To do this well, a manager needs skills in marketing, to fill vacancies, accounting and finance, to budget and track performance, construction and maintenance, to protect the asset, and human relations, to work with owners, tenants, vendors, and staff. These skills are exercised within the limits of the management agreement, which defines what the manager is allowed to do and how success will be measured. Management agreements, budgets, and reporting. The management agreement is the core legal document in property management. It establishes the agency relationship between the owner and the manager and spells out the manager's authority, responsibilities, compensation, and reporting duties. It identifies the parties, describes the property, sets the term and cancellation conditions, states the owner's goals, allocates costs, and explains what reports the owner will receive and how often. It also includes an equal housing opportunity statement for residential properties, tying management back to the fair housing principles you learned earlier. Because a managed property is an investment, the owner expects to see clear financial reporting. Managers prepare operating budgets that estimate income and expenses for the coming period. They analyze potential gross income, scheduled rents plus other income if fully occupied, effective gross income after vacancy and collection losses, net operating income after operating expenses, and cash flow after debt service and reserves. For example, a 10-unit building might have potential gross rent of $12,000 per month, but effective gross income could be $11,200 after one vacant unit and one partial non-payment. And net operating income will be lower still after taxes, insurance, repairs, and management fees. These numbers are turned into regular reports, cash flow statements, profit and loss statements, and budget to actual comparisons. As a salesperson, you are not expected to be a CPA, but you should understand these terms well enough to discuss performance with owners and recognize when a property is underperforming because of high expenses, excessive vacancies, or poor rent collection. Leasing, landlord-tenant duties, and risk. You revisited lease concepts from earlier chapters. But now from the manager's perspective, a leasehold can be for years, a fixed term, from period to period, such as month to month, at will, or at sufferance. Lease rent structures can be gross. Owner pays most expenses. Net, tenant pays some or all expenses. Percentage, rent tied to sales, often in retail, or graduated, scheduled increases. The manager must understand these structures to set rents appropriately, explain them to tenants, and project income correctly. Landlords and tenants both have statutory rights and responsibilities, often based on versions of the Uniform Residential Landlord and Tenant Act. Landlords must provide habitable premises, including safe structures and working systems such as heating, cooling, plumbing, and electrical, and perform necessary repairs within a reasonable time. Tenants have the right to quiet enjoyment and to a habitable dwelling, and in some circumstances may have remedies such as withholding rent, making certain repairs and deducting the cost, or terminating the lease if the landlord's failures are serious enough. In return, tenants must pay rent on time, follow rules, keep the unit reasonably clean, avoid damaging the property, prevent others from doing damage, and use the property for its intended purposes. Eviction is one of the most serious actions in property management and must follow state law exactly. Actual eviction requires proper notice, a court proceeding, and a judgment for possession before a sheriff or constable may remove a tenant who refuses to leave. Constructive eviction occurs when a landlord's actions or failures make the property unfit for its intended use, and the tenant vacates and treats the lease as terminated. Both scenarios illustrate why understanding landlord-tenant law, fair housing law, and due process is critical in management. Risk management runs through everything a manager does. Risks include personal injury, property damage, natural disasters, crime, employee misconduct, and professional errors such as mishandling trust funds. Risks can be avoided, controlled, transferred with insurance, or retained with careful planning. Life safety systems like smoke detectors, sprinklers, fire doors, and safe egress routes are essential, as are appropriate insurance policies for casualty and liability. Tenants also need their own policies to protect personal belongings and business operations. Mishandling trust funds or ignoring safety issues can result in disciplinary action, civil liability, or worse. The management business and professional path. From a business perspective, property management is a separate line of work with its own clients, systems, and income models. Managers obtain business by building reputation, demonstrating competence, and clearly communicating how they will achieve the owner's objectives. A management plan for a new assignment will analyze the local market, vacancy, and absorption rates, the property's physical condition, financial history, and competition. It then outlines strategies for rent setting, marketing, maintenance, capital improvements, and risk control. You also learned that property management can be structured in different compensation models. Some firms charge a percentage of collected rent, others a flat fee, and some use combinations or revenue-sharing approaches in commercial settings. Asset managers focus more on the financial performance of portfolios and look for ways to increase revenue and reduce costs across multiple properties. Professional development is critical in this field. Organizations such as IREM, BOMA/BOMI, NAA, and NARPM offer designations that signal specialized training in building operations, apartment management, residential management, and other niches. As a salesperson, you may use these resources to deepen your knowledge or to identify appropriate experts for referrals. Is property management right for you? This chapter also encouraged you to be honest about your own skills and interests before stepping into property management. Just because your real estate license allows you to manage property does not mean it matches your strengths. Successful managers have strong people instincts, handle conflict calmly, balance owner and tenant perspectives, and enjoy problem solving. They also appreciate systems, written policies, and careful record keeping. You must always start by talking with your broker. Not all brokerages are set up to do property management. Some brokers do not want the added liability, trust accounts, or increased regulatory scrutiny. Others may restrict property management to a small group of trained agents. If your broker allows you to participate, you should seek formal education, mentoring, and legal guidance, rather than flying by the seat of your pants. The chapter also showed how easy it is to drift into accidental property management. Simple favors, such as paying a bill, Turning on utilities or overseeing pool service can cross into management activities if you do not have a written agreement and clear authority. You must also respect the limits on unlicensed assistants who may not collect rent or perform tasks that require a license. When in doubt, step back and involve your broker or refer the client to a professional management firm. Review summary. In summary, Chapter 23 tied property management back to key themes from earlier lessons. Agency duties reappear in the management agreement. Contract principles show up in leases and management contracts. Finance concepts are applied through budgets, income analysis, and cash flow. Fair housing and landlord-tenant law shape how tenants are screened, treated, and if necessary, evicted. Risk management builds on your understanding of liability and insurance. As a general salesperson, you are not expected to become a property management expert overnight, but you must recognize the basic structures and risks. This helps you protect your clients, stay within your competencies, and work effectively alongside property managers, attorneys, and your designated broker. Discussion Prompt 1. How does a clearly written management agreement protect both the owner and the property manager? Suggested answer. A clear management agreement spells out the manager's authority, duties, and limits, along with the owner's responsibilities and goals. This reduces misunderstandings about who approves repairs, who can sign contracts, and how decisions are made. It also establishes how the manager will be paid and what reports the owner will receive. When a dispute arises, both parties can point back to the written agreement instead of relying on memory or assumptions, which lowers the risk of lawsuits and regulatory complaints. Discussion Prompt 2. Why is understanding net operating income and cash flow important when an owner asks whether to raise rents or invest in improvements? Suggested answer. Net operating income and cash flow show how much money the property actually generates after operating expenses and debt service. If the owner wants to raise rents or invest in upgrades, the manager can use these numbers to test different scenarios. For example, a planned renovation that allows for higher rents might increase net operating income even after the cost of repairs, while a rent increase in a weak market might lead to higher vacancy and no real gain. Understanding these numbers helps you give realistic advice instead of simply guessing or focusing only on gross rent. Discussion Prompt 3. What are some warning signs that you may be drifting into property management activities without proper authority? And what should you do if that happens? Suggested answer. Warning signs include regularly handling repair calls, paying vendors, coordinating maintenance, collecting rent, or making promises about how a rental will be run, all without a written management agreement or clear direction from your broker. If you discover you are doing these tasks informally, you should immediately talk with your broker. Stop activities that exceed your authority, and either put a proper management agreement in place under the brokerage or refer the owner to a qualified property manager. This protects you, your license, and your broker from unauthorized liability. Closing remarks. Chapter 23 helps you see property management not as a side task, but as a structured, regulated, and potentially rewarding specialty. It combines legal knowledge, financial analysis, people skills, and systems thinking. Even if you never manage property yourself, this chapter prepares you to recognize where your responsibilities end, when to involve your broker, and how to guide clients toward competent management help. As you move deeper into your real estate career, remembering the lessons of this chapter will help you avoid costly mistakes, protect consumers, and collaborate effectively with the professionals who keep investment properties running smoothly day after day.